right, thank you everybody. Good afternoon, and depending on your time zone, good morning. My name is Maria Verbaite, and I'll be producing today's webinar, so let's get started, and thank you for your patience. On behalf of everybody at Reunion, I'd like to thank you for joining our webinar, Navigating the Tax Credit Transfer Process. We designed this webinar with corporate taxpayers in mind, and we'll hold similarly buyer-focused webinars on a quarterly basis, so we can equip you, our buyer community, with our latest market insights and answer whatever questions you may have. I'm joined today by Reunion's co-founders, Andy Moon and Billy Lee. Before handing it over to them for introductions, I'd like to walk through a few house cleaning items. We are recording the webinar, so folks who weren't able to join us live can watch later. If you are unable to stay here for the entire duration of our session, no worries. You'll be able to access our recording, which we will publish on our website in about a week. We have disabled the audio and chat for participants to minimize background noise. To play it safe, though, we'd ask you to please keep yourself on mute during the webinar. We would, however, welcome any and all questions. Please send them our way. We want to keep the session informal and interactive. You should see a Q&A button at the bottom of your screen. When you submit a question, which you can do so anonymously, Andy, Billy, and I will receive a notification. Although we may not answer a question in real time, we will do our best to address as many as possible. And as your producer, I'm reserving the right to elevate fantastic questions while Andy or Billy might be talking. We recommend using a gallery view, likely in the top right corner of your screen. Andy and Billy will be talking back and forth, and we don't want you to get seasick if your screen jumps around with presenter view. Finally, if you experience connectivity or accessibility issues, please email me, Maria, and we will troubleshoot behind the scenes. I'm at maria@reunioninfra.com. Once again, thank you for joining us. Now I will turn it over to Andy to preview today's agenda.
Hi, everybody, and thank you so much for joining today's webinar on navigating tax credit transfers. We have a lot of content to cover here in 1 hour. We'll start with a brief overview on market trends and pricing, which is always a popular topic that people love to hear about. After that, we'll dive into the tax credit transfer process, including some of the key terms that we hear in negotiations, as well as due diligence. We do want to hear your questions. We would love to get questions from you in the Q&A, so feel free to enter those into the chat box, and we will address the questions as we go through the presentation. As a quick introduction, next slide, please. As a quick introduction, Billy Lee and I met 15 years ago at one of the leading solar development companies, and we certainly would have loved to have tax credit transfers as an option to finance projects back then. We led many of the very first solar project financings from private equity investors and major tax equity banks such as JP Morgan, US Bank, and Wells Fargo. And we started Reunion to focus exclusively on tax credit transfers. And it's just been fantastic to see the level of interest from corporations that are now making their very first tax credit transfers. I'll let Billy give a quick introduction to himself as well.
Yeah, thanks, Andy. Very nice to be here today and look forward to the discussion. My name is Billy Lee. I've been thinking and working on renewable energy financing, tax equity, and tax credits for almost the last 20 years. Really excited to have transferability as part of the financing repertoire, and look forward to answering all of your different questions today. Next slide.
All right. Well, it goes without saying in terms of market trends that the market for tax credit transfers has really heated up in 2024. You know, every conference we go to on the wind, solar, battery side, but also on the tax side, now features presentations on tax credit transfers. And I would say that just as a quick update from our end, you know, Reunion has closed several $100 million of tax credit transfers in 2024, and we are in active due diligence and negotiation on over $1 billion of additional transfers. So the market is very active, and we're excited to see so many of you on the webinar today to learn more. A few trends that I will highlight to kick things off. So everybody wants to know about pricing, so let's talk about that first. One trend we see is that larger projects do tend to carry a smaller discount versus smaller projects. And I think two reasons for that. One is that currently we see larger buyers wanting to deal in general with larger projects, which leads to relatively more competition for these opportunities. And I think second, larger projects provide an absolute larger dollar amount of tax savings. So the often mentioned, $700 million tax credit purchase by Fiserv in December had a 4% discount, which translates to $28 million in tax savings, which is still a very large number. For smaller projects, typically a buyer needs a larger discount to motivate them to go through the effort of buying a credit. I think similarly on smaller projects, small projects under, say, a couple $1 million are relatively more expensive to insure. And that's something that we do expect to see innovation on in the coming months. On the bonus credit front, we have been excited to see more and more projects in our platform featuring Energy Community Bonus, which is an extra 10% bonus adder. Thankfully, this bonus credit adder is in general fairly straightforward to due diligence. And so that's been a driver of larger credit volumes. And I think finally, timing of payment has emerged as a very critical factor for buyers looking to purchase tax credits. I think on the spectrum of buyers, we see sort of two different flavors of buyer, if you will. One type of buyer is cash rich, and they're less concerned about the timing of payments. And so for those buyers, they're really looking to opportunities that will save them the largest absolute dollar amount of tax liabilities. And for them, timing of payment is less important. However, for the majority of buyers, most buyers are sensitive to when they make the payments for the tax credits. And so the reason for this is many tax and treasury teams want to avoid having to go out of pocket in order to purchase the credits. So we'll go over some very specific scenarios that are attractive to buyers that are looking to minimize the impact of their cash flows. All right. Maria, can we take a quick look at the poll and go to the next slide? So we'll spend a very short amount of time on this slide, but in general, okay, great. So let's do a quick check on sort of where we're seeing folks on this webinar. We see a lot of people who are still learning, about a quarter that are actively looking for credits, and about 7% or about 10% total have closed a deal or are currently closing a deal, which is great. We're seeing a pretty good distribution of expectations on where to purchase credits, but the largest majority of viewers today are looking at credits in the 92 to 93 cent range. And that aligns well with sort of the ITC amount. So as a general overview, we are seeing PTCs for the current year trading in the mid-90s per dollar of credit. And this sort of number reflects the all-in return to the buyer. So that includes any cost of insurance and any sort of intermediary fees to sort of set up the transaction. De-risked ITCs, so these tend to be larger in volume with proven technologies such as wind, solar, and battery storage. These tend to trade in the low 90s per dollar of credit. So that aligns with what many of you all are looking for. And then there are, of course, more complex ITCs that can go into the 90-cent range or even the 80-cent range if they are smaller projects, less proven technologies, more complexity overall on the project. So as you can see, there's a range of pricing that's available, and a lot of it just depends on sort of the level of risk and complexity that a particular buyer is looking to undertake. Next slide, please. So just to dive a little bit deeper on the cash flow example, as I mentioned, we do have a lot of buyers that come to us saying, I would really like to make sure that I don't go out of pocket in order to purchase a tax credit. And the most straightforward way to do this, of course, is through a payment structure typically with Section 45 PTCs, but this can also work with Section 45X advanced manufacturing production credits. It can also work with portfolios of ITCs that, for example, are on rooftops of commercial buildings. But the overall idea here is that at the end of each quarter, the buyer would look back, see what credits have been generated for the previous, call it quarter, and just pay for the amount of credits that have been generated. In this particular example, we take a taxpayer that in the status quo in gray is paying $200 million in taxes to the IRS per year, which translates to a $50 million estimated tax payment each quarter. In this example, we assume that the buyer purchases $100 million of production tax credits, and they commit to that in Q1, and therefore they are able to offset $25 million in tax payments to the IRS each quarter. In this particular example, we are assuming a 5% discount. So essentially, instead of paying the IRS that $25 million that they would have paid at each quarterly payment date, they pay a clean energy developer $23.75 million around the same time or even a little bit after they would have paid the IRS. As a result, they never go out of pocket for cash, and they end up saving $1.25 million in taxes each quarter. So for many buyers, this is great because, you know, instead of paying the IRS $25 million, they're paying a smaller amount to enable clean energy and get a nice $1.25 million in tax savings, and that savings amount is not subject to further taxation.
And I think, Andy, just to chime in here, we've been surprised, frankly, that cash flow in many cases is more important than, you know, relative discount savings, right? So, you know, maybe when transferability kicked off last year, everyone was just focused on, oh, I get a 6%, 7%, 8% discount. Really, for many tax credit purchasers, the timing of payment and cash flow efficiency is very important. And that's why we do focus a lot on this in terms of evaluating different opportunities.
Thanks, Billy. We'll go to the next slide. So one other common situation that we see is the IRS in their guidance was very clear that a taxpayer can use tax credits that they purchase or that they intend to purchase to offset their quarterly estimated tax payments. And that has opened the opportunity for a buyer to commit to purchasing a tax credit, but not paying for the tax credit until later in the year. And so we see this happen, for example, when, you know, a developer is planning to place a project into service in Q2 or Q3. They are willing to accept the payment. You know, payment never happens until after the tax credit is generated. And so you can see an example here where that same $200 million taxpayer is committing in Q1 to buying $100 million in Section 48 investment tax credits. They are therefore offsetting $25 million in tax payments per quarter. However, they are not paying for they're not paying the developer for the tax credit until Q3. And what that creates in Q1 and Q2 is a net benefit of $25 million. In other words, the taxpayer has offset what they would have paid to the IRS, and therefore they have an additional $25 million in cash availability in Q1 and Q2, and then they're making a larger payment in Q3 to purchase the credits from the developer. So this structure is also emerging as a popular one where buyers say, hey, that's great. I have more cash availability in the early part of the year. I am making a bigger payment in Q3 or even in Q4, but that still creates some benefit for me in terms of timing of cash payments.
So we do have a few questions, and both of them revolve around kind of the concept of what does the IRS mean by intending to purchase, right? When you ultimately reduce your estimated tax payments. In general, there was not a lot of detail around that. And I think in practice, we've seen different taxpayers view that differently. Some folks are okay with a signed term sheet to start doing that. Others are, you know, want a fully executed purchase and sale agreement. So, you know, I think we see kind of the gamut of what the level of risk that people are ultimately wanting to take. In the end, you know, if you reduce your estimated taxes and you don't have those credits at the end of the year, that does open the taxpayer up to underpayment penalties upon final return.
Yeah, just a few items to add there. If a credit, if a buyer had intended to buy a credit in Q3 or Q4, and that project slips and it doesn't get placed in service in the appropriate tax year, then, as Billy mentioned, the buyer could be subject to underpayment penalties. Now, of course, the sort of one way to solve that is for the buyer to find replacement credits, find other credits to ensure that they are able to buy the amount of intended tax credits for the year. I think the other item that Billy mentioned is, given the IRS guidance just as sort of intend to purchase, that's really up to the buyer and their auditors in terms of their level of comfort in sort of taking those reductions in estimated tax payments. And I'd say probably it does span the gamut, and we're not providing tax advice, but we've seen commonly folks, the highest number of folks comfortable with sort of taking that after they've signed some sort of tax credit transfer agreement. Any other questions we should address right now? Let's see. Okay. So briefly, we'll go over the tax credit transfer process. We have a 7-step process that we've seen through the dozens of transactions that we've worked on. The first step is often the longest, which is building the internal business case. So typically in these transactions, we work with tax and treasury teams, but often the CFO can get involved, legal gets involved, sometimes even sustainability is involved. And so ensuring that all of the internal stakeholders are bought in and on board is of critical importance to do upfront. And the reason for that is because when there are attractive opportunities that are looking to sell credits, those can often get claimed very quickly. And so if a buyer is interested in an opportunity, but it takes another month to get all the internal approvals during that time, that opportunity may disappear. And so we strongly encourage buyers to ensure that all the relevant stakeholders that need to be around the table have sort of blessed and gotten on board with these transactions upfront. And we are always very happy to help run workshops to get all the internal stakeholders to understand the opportunity and sort of sign off on it early on. Once the buyer has decided to purchase a credit, we begin the process of reviewing projects and signing a term sheet. In the case of Reunion, we will go through our marketplace that has over $7 billion of tax credit opportunities and curate opportunities that we think would be a match based on the criteria that the buyer is looking for. There often is some back and forth with the seller to agree on the key terms, such as pricing, timing of payment, indemnification, insurance, etc. But we provide a standard form term sheet that we use to sort of efficiently provide that offer to the seller. We keep our term sheet pretty light on purpose because until the term sheet's signed, the seller could go a different direction. And so, but once the term sheet is signed, that kicks off a period of exclusivity during which the buyer has the opportunity to really focus in on that project, do comprehensive due diligence, and negotiate the tax credit transfer agreement. One area that we have ended up leaning heavily into is a preliminary due diligence check. And this has come out of our learned experience that, many tax and treasury professionals are doing this for the first time. And therefore, it's very important to provide a good sense upfront of what potential issues might be on a given deal. So once a buyer has expressed interest on a specific project, Reunion will go through with our standard 25-point due diligence screen just to identify any potential issues that might sort of become bigger issues later down the line. And we want to do that before the buyer spends a lot of time and also expense going through the diligence and legal process. Once we complete that check, we then work very closely with the buyer to do sort of the bulk of the negotiation, which is comprehensive due diligence, ensuring insurance coverage is adequate if that's needed on the project, and signing the tax credit transfer agreement. For the due diligence piece, Reunion will sort of quarterback the process, ensuring that the data is collected in a sort of buyer-friendly and standardized format, and that you have all the pieces that are needed for proper documentation. If tax credit insurance is required, which it often is, unless the seller is providing a creditworthy guarantee, we ensure that the coverage levels and the terms are to your satisfaction. And finally, we bring a form tax credit transfer agreement to the table as a starting point to reduce the back and forth and the drafting costs, with really a goal of focusing buyer and seller on the most important parts of the negotiation process, which Billy will go over in the next couple of slides here. Finally, we ensure that the transaction closes if the closing process is post signing of the or the funding process is post signing of the tax credit transfer agreement. We sort of make sure that happens smoothly, and we provide reminders because there are some filings that are required post closing of the tax credit transfer. I'll stop there for any questions, and if not, we'll dive right into key terms that we see getting negotiated in the tax credit transfer agreements. Okay, well, we have a couple questions here. So Reunion's inventory of transferable credits, last I checked, we have over $7 billion of credits on our platform, although I think that number might be quite a bit higher at this point. It sort of increases every day. Are you able to deduct the insurance and diligence costs? Billy, do you want to take that one?
Sure. So in general, the seller of the credit purchases insurance. So that is not necessarily a cost that the buyer would incur. Typically, the buyer's an additional insured, but the seller does procure it. And that's not always the case, but I would say in the majority of cases, that's the way it works. In terms of deducting other due diligence costs, this is one area where I think I know the answer, but I don't want to speak out of hand. Let us get back to you. I don't think there was, off the top of my head, I don't think there was any guidance specifically on this. I think in general, I think most of our buyers are viewing that diligence costs act like any other transaction costs and are deductible. But again, let us go back and confirm that for you guys.
Awesome. One thing I'll note is that the transaction costs related to intermediaries such as Reunion, typically the buyer requests us to collect that fee from the seller. So it's treated similarly to the way insurance is. It's sort of an all-in cost that's included sort of when you purchase the credit.
I know there's some other questions, but let us maybe get through the next couple slides, and then I think that will be helpful to answer some of these other questions. So Maria, why don't we go to the next one? So let's talk a little bit about what a tax credit transfer agreement looks like. From the poll, it seems like there's a lot of folks who are kind of in the earlier stage of transacting. So tax credit transfer agreements, they're actually fairly simple agreements. Some are longer than others, but in general, the headline terms are pricing and payment. So typically there's a discount rate that's negotiated during the term sheet phase. Again, we talked about payment timing, and a lot of times the deals will be simultaneous. Sign and close if the credits have been generated. Sometimes you'll have a signing and then subsequent closing when the credits are generated in the future. And sometimes there's just a bespoke, hey, the credits have been generated, but we're not going to pay till 9:30, and that's incorporated in the deal. So there are some areas where buyers can negotiate here. Transaction costs. I think a lot of deals we're seeing where the buyers and seller basically pay their own transaction costs. I think more and more in deals, we are seeing buyers asking for some reimbursement of their legal and advisory costs. Again, this is a negotiated item, and typically, if there is a provision to reimburse some some transaction costs that the buyer incurs that's capped, and typically sellers would just look at that as, from an economic standpoint, a reduction of purchase price. So we can certainly guide you guys on what makes sense in different deal contexts. The next kind of big bucket at TCTA is reps and warranties. There's a lot of standard reps. The seller is an eligible buyer. They own the project. The credits that are generated are, Section 48 credits, and the cost basis is such and such. Either that they've been exempt from PWA, or perhaps they started construction before a certain date. And to the extent that there's any bonus credits, what those are and how they qualify. So really the reps and warranties are obviously they play a role contractually, but they are a way to kind of guide the due diligence, right? To make sure that the buyer and seller are covering all the different areas that need to focus on. I think a big some tension is on, especially on the bigger deals with sellers who have larger balance sheets, is what can be a rep and what reps need real due diligence behind them. And again, that's a discussion that happens often. Indemnification is probably one of the biggest items in tax credit transfer agreement. As I'm sure all of you guys know, the IRS puts the risk of loss, so to speak, of the credits on the buyer. So to the extent that they dispute a credit, they will go after the buyer of the credit initially. So that typically there's an indemnity that indemnifies any loss of these credits that the seller provides. Now, I think we're seeing more and more that really these indemnities are, no fault indemnification. So if anything happens, right, if the credits are disallowed, reduced, recaptured for basically whatever reason other than specific actions of the buyer, then this is covered in indemnification. So it is kind of akin to like kitchen sink, like everything is covered. I think, I think in general, the loss of credit, but also interest and penalties, tax gross up, which is to the extent that there is an indemnification that's characterized as a taxable payment. The buyer will want the seller to gross up that indemnity. So if the buyer suffers a loss of $100 and they get paid for $100, they actually have to pay taxes on that $100. So they're going to want something like $130 to make everything even. And then interplay with insurance. This is one area that's I would say evolving. A lot of these deals, especially the ITCs, have insurance. So we're seeing more and more where sellers are basically saying that insurance is going to be the primary indemnification. And typically indemnifications and insurance are paid out at the final determination. So there's not a situation, typically not a situation where the buyer is looking to be indemnified prior to that. But in general, there's sometimes some interplay with insurance as to whether the seller, whether the buyer should first look to get paid for insurance and then go to the seller to the extent that there are any gaps. Next slide. Real quick, there's a couple other big areas. Limits of liability is often, formulaic, where you say, okay, listen, the limit of liability is my purchase amount plus any tax gross up plus any penalties, interest plus contest costs. You can also just structure it as, hey, listen, the limit of liability is $50 million, right? And that's, again, a negotiated amount. Audit participation rights are pretty important. Typically, a buyer is going to control its own audit, and a seller, to the extent they're audited for some reason, they will control their audit. But in the scenario where a buyer is audited and there are document requests or inquiries from the service, then the seller typically has a right to participate because ultimately they are wearing that risk. And one thing that's not noted here is typically insurance, if there is tax credit insurance, those insurers will also want rights to participate and get knowledge because ultimately they're going to be the ones cutting the check. And then least but very important is making sure everyone understands what the post-closing obligations are. Obviously, a lot of deals are getting closed without having the IRS registration number in hand yet. That is a separate process, which we do believe is a ministerial process, but is, takes some time and doesn't always line up to the transaction process. So you'll need to receive that number. You have to then sign the transfer election statement, and then both parties have to properly file their tax returns. Document retention is an important thing that we focus on as well. So there is a concept of minimum required documentation and reasonable cause. If ever, the IRS says there was an excessive credit penalty, you could be subject to a 20% penalty. But if there's reasonable cause and the guidance lists out, a bunch of different ways to establish reasonable cause, and all of this is kind of common sense due diligence. And again, we make it a point to make sure we retain all this documentation to ensure that it's available quickly to respond to any inquiries down the line.
Yeah, and I think the IRS put this very purposefully in the regulations to incentivize buyers to do proper diligence. I mean, the idea is that, taking a look at the projects and understanding what you're purchasing is an important part of the process. And that's where intermediaries like us can really just help package that information and make sure that you have that in a neat and well-documented manner.
So there are a couple questions, very great questions. In general, for the TCTAs, is it a standard and template agreement, or does it vary on type of credit? Who generally initiates the contract, seller, buyer? It's kind of, at this point, still kind of all over the map. There is not one standard agreement that we've seen. I feel like every law firm has its own agreement. A 45X agreement will look much different than an ITC. So it is kind of a discussion on, where's agreement being is being generated. Like, we have one ourselves, and we don't always use it because, again, it's a discussion between the parties on what is the path of least resistance, right? If the buyer has already executed an ITC and they just want to do another one, it probably makes sense to start with that. If nobody's done a deal, maybe we start with ours because we know that agreement. So there is a discussion about it. Now, the guts of the TCTA, I don't know. I'm biased because I've read so many of them at this point. They all kind of have a lot of similarities. So, we hope over time that this does become standardized to a certain extent, but we're still in the early innings, as you might imagine. Another question is, what advisors and due diligence does a buyer usually bring to the table? Or what other advisors and I assume due diligence advisors? Again, this runs the gamut. We've seen folks hire the Big Four and really dig in deep. Some folks really lean on us and review our material and ask some smart questions, but it's very much a DIY affair. Some folks rely solely on counsel. So again, it depends on the different types of taxpayers and their knowledge in this area. Obviously, if the taxpayer is from a completely different industry and they don't know much about energy, that's we see them really lean in, especially on their first deal, to hire very very comprehensive due diligence advisors and other people. maybe who've been ancillary to, maybe have been buying renewable energy for the last 5-10 years and kind of know a lot. Maybe they have a lighter touch.
Yeah, and we see others that look for a hybrid approach as well, where they have somebody like us manage the due diligence process and help guide the buyer on, hey, this is an area where you need specialized tax counsel or legal counsel to take a deeper look. And that's a way to sort of manage costs where you don't have sort of a you don't have an accounting firm or a legal firm sort of running the entire due diligence process.
Let's get in. There's a couple more questions. Let's go to the next slide. Let's do the due diligence. Let's zoom through due diligence real quick. And we'll touch on some of these other questions, but keep them coming. This is what we love. Answer a lot of these questions, because if you have a question, I'm sure there's 10 other people who might have the same question. And everyone's doing it anonymously anyway, so I don't know who's asking. ITC due diligence. So ITCs are probably of the credits that are being traded the most, 48, 45, 40, 45X. ITCs are probably the ones that have the most comprehensive due diligence, because there is a 5-year recapture period. So you do need to think about what could happen after year 1. And just to reiterate, recapture occurs if within 5 years, the asset is no longer energy property of that original taxpayer. So what that means in practice is the solar project blew up and was not rebuilt. The seller, is in default of its loan agreement, and the lender foreclosed, causing a change of control. Hopefully this doesn't happen, but a seller in contravention of all of its agreements goes and sells the project anyways. I've never seen that in my career, but it is a risk. So the things that we think about in ITC, first off, are when was a project placed in service, right? And that the place in service date is when the credit is determined. Secondly, we want to look at the offtake or revenue contract to the extent necessary, right? Like, we don't really care that it's a 20-year PPA with an investment grade offtaker if, for example, you're a project that's selling into a wholesale grid like I don't know, PJM or MISO, and even if you lose that offtake agreement, you're still selling power. Ultimately, that what has to happen for ITCs is that project needs to continue to be in service. So, but typically, having a long-term revenue contract allows a project enough cash flow to continue operating. Installation and O&M contracts, again, to this extent, we want to make sure that the project was built to a certain quality, that is being maintained to a certain industry level. Again, not to maximize production, which is what you would think about in a financing context, but to ensure the project continues to be viable. The cost segregation study is really the meat and bones of what the study that says, yes, this amount of credits was generated. ITCs is, unlike the production credits, is based off of cost. So you do need to understand exactly how much that costs, and there is a very specific way to allocate costs between different cost categories. An appraisal is also necessary if there is what's called a step-up transaction. So step-up transaction is basically, and we're going to summarize this very quickly, it's basically a transaction where the taxpayer can use fair market value as its cost, as opposed to just the hard costs and direct costs to build. There is diligence that needs to happen on what that step-up transaction looks like. And then to support that fair market value, typically want a third-party appraisal. A lot of cost segregation consultants provide appraisals all in one. Some are separated, so just be aware of that. Site control is another big one. Again, we want to make sure that the project has full unencumbered rights to operate at its specific location for 5 years. If for some reason it gets booted off the property in 3 years, that can cause a recapture.
Yeah, and maybe I'll just jump in here. These last three items are really focused on ensuring that we've taken a look at any situations that could lead to an eventual recapture during that 5-year recapture period. So site control is really ensuring that the project is not kicked off the property and placed out of service. Debt structure, if that's at the project level, making sure that there's a forbearance agreement such that the debt won't recapture the project, leading to recapture. And then liability and P&C insurance coverage, so ensuring that there's adequate coverage to continue operating the project during the 5-year recapture period. So these are very specific items to ITC due diligence, but ones that we always take a look at to ensure that there's that those risks are mitigated.
Absolutely. And just to zoom through some of these, PWA, prevailing wage and apprentice, this is going to be more and more common because any project that didn't start construction before January 29th, 2023 has to pay prevailing wage and apprenticeship and hire apprentices to a certain level. Now, so there is some standard of diligence and that is being developed now. Now, I would say that PWA is very important. There is a cure period. So to the extent that the IRS says, I challenge that you developer seller has complied with PWA, there is a way to just pay a penalty and true up labor costs without losing your credit the next day. And then we touched on bonus credits. Energy community by far is kind of the most common one. We're seeing some low income communities or some awards recently. And then domestic content, that's domestic content. We are seeing those on some projects, but there's a lot of still ambiguity on the regs there. So I think people are still focused on exactly what that's going to look like going forward. Let's move on to the next slide. PTC due diligence. In general, PTCs are a lot simpler because they're not cost-based and they are not subject to recapture. So once you generate an electron from a wind or solar facility that elects a PTC and you sell that to a third party, you get a PTC. It's not subject to recapture, and that purchase and sale to a third party is a lot easier to diligence than, hey, my cost is X or Y. So typically for PTC due diligence, we'll look at the place in service date. Again, that's when the 10-year PTC starts. So if you're 3 years into a PTC, maybe it's less important. It's really important when you're buying credits at the start of the 10-year window and at the end of the 10-year window, because you're going to want to know exactly when that 10 years starts or begins. Begin construction date. Again, this is important for projects that were placed in service between 2017 and 2021 inclusive, because there was a period of time where the PTC rate for wind projects declined. And so there was a lot of begun construction strategies in 2016 that's been 8 years from now since now. So going back in time and recreating and reanalyzing that begun construction strategy is important. Otherwise, the begun construction rules apply for PWA. So you want to get in you want to make sure that projects began construction before January 29, 2023 to be exempt from PWA. And then we are seeing a lot more 80/20 projects, repower projects. So these are where you have an existing wind farm. It's been operating for over 10 years. There's no more PTC. You go and add new equipment. So this is one area where the cost does matter. And typically you have to spend 80% of the fair market value to get a new 10-year window of PTCs. PWA and bonus credits are basically the same as ITC, so I won't hit that here.
Yeah, and I think what this really highlights is, there is some more complexity on the ITC due diligence, as well as the recapture consideration. And as a result, that leads to a larger discount for the ITC transactions. And so, we do see quite a few buyers that are excited by, ITCs because it delivers a larger absolute sort of dollar figure of tax savings. Whereas other buyers will say, hey, I'd prefer a simpler transaction that doesn't have recapture, and instead look for PTCs or advanced manufacturing production credits. Now, that said, it is important to note that even on a PTC, there is often a fair amount of due diligence required. It really depends on the level of sort of preparation a buyer would like to have. Some buyers really want to have everything completely buttoned up in the event that there's an IRS audit tomorrow. And so when that's the case, getting pretty deep on understanding when did a project begin construction, that it's important to think carefully about sort of what type of substantiation is sufficient to prove that. And that's where diligence also comes into play on PTCs.
All right, so there's a couple questions we're getting here, and I'll just remind you, if you do have a question, just type it into the chat. We don't have a way to unmute people. Sorry about that. So one question very very related to this particular discussion is, are there certain type of credits that are the least risky, in that shortly after purchase there's little risk of recapture of disallowance? So yes, the PTCs and the 45X AMPCs, advanced manufacturing production credits, don't have any recapture. That doesn't mean that they can't be challenged. That just means that if something happens to the project a day after you bought credits, that has no bearing, right? You've bought credits that were generated for both credits that were sold to a third party, although the 45X does have an ability to sell to related parties. But once it happens, there is no recapture risk in the sense of ITCs have risk of Section 50 recapture. So I think that for a lot of taxpayers, that's a warm, fuzzy blanket. I think in general, operating PTC projects in the market are perceived to have the least amount of risk, and therefore have the highest pricing. I think 45X is getting to that point where folks, again, perceived risk is there is a lot less risk than an ITC. And 45X, we're working on a number of those right now. Unfortunately, we don't have a diligence slide, but it's very similar to PTCs, where you are looking at, is the eligible component, was it manufactured, assembled in the US? Was it sold to a third party? Was there substantial transformation? If it's been integrated into another component, there's some other tests there. But in general, the risk to a buyer, these are all fairly easy to diligence. And yes, there's less perceived risk. ITCs, there's more stuff to look at in the upfront deal, and also more potential for things to be exposed to future operational risks of the project, which are, I think are manageable and fairly, I wouldn't say de minimis, but fairly, the likelihood is fairly low, but for that reason, these credits do trade at a wider discount and often need insurance.
Yeah, and one note I'll make on the 45X advanced manufacturing credits, those are not subject to prevailing wage and apprenticeship requirements. Also, with the Section 45 credits, if the project began construction prior to January 29th, 2023, they also are sort of grandfathered and do not require compliance with prevailing wage either. And so we do see projects such as a wind project that was placed into service in 2022 or 2020, that does not require compliance with PWA.
Right. The last question we get is, how many transactions have you seen challenged by the IRS, and what was the outcome? So, we're not aware of many of these happening yet, just given that a lot of the transactions started in the market really heated up in kind of late 2023. I will say that we do know of one. I believe the taxpayer is in the CAP program, so they're kind of under continuous kind of investigation audit, if that's what you call it. And they have asked questions about 2023 credits, but in general, I think what we are hearing, and especially the insurers are reiterating, is don't expect, some of these audits might happen down the line, and the audit process could take, a long time. So typically in an insurance, for insurance, if you're relying on that, that's why it does have kind of a 7-year period. And that 7 years is when an initial audit is triggered as opposed to concluded. So insurance will cover a final determination that started in the 6th year of the insurance policy, but that concludes maybe 3 years later.
Yeah, and one thing I'll add is that, for example, the investment tax credit has been around since the early 2000s, and so there has been the opportunity for the IRS to challenge tax credits coming from, say, solar investment tax credits. We pulled a number of tax counsel that's been involved in very many of these deals. Nobody could think of a time when sort of a parent guarantee was called due to a recapture. So recapture has been actually very uncommon amongst ITC transactions historically, prior to the advent of transferability. There have been a couple examples where the step up in the cost basis was challenged, so the amount of tax credit. But that's something that we can thoroughly due diligence, the way that Billy mentioned, by really validating that the cost basis of the project was adequately captured and documented.
So I think there's a couple last questions here, and these are probably the last ones we can get to before we have to wrap it up. But there's a couple questions on how do you diligence the creditworthiness of the seller, and what diligence, if any, is done on the buyer. So in general, both the buyer and seller need to be eligible. So that is, we do look at, for example, the seller is an eligible seller, and take a look at, if it's a partnership, you do need to go look at the upstream ownership to make sure that there's no disqualified entities in there, to make sure that, if there's individuals that are subject to the at-risk rules, that there's additional layers of diligence, because that could implicate the nature of the credits. On the buyer side, very similar thing. Typically, I would say 98% of our buyers are widely held C corps, which is basically it makes you eligible to buy these credits. If you are a partnership, or if you are closely held, again, you do need to think about kind of the at-risk rules. There is some exceptions to closely held corporation rules that we've talked about in other contexts. But we do focus on diligence on both sides from an entity standpoint. And from a credit standpoint, if the seller's credit is important, ultimately, because that is the seller or its parent guarantor is what's standing behind the indemnity. If anything goes wrong, if you don't have insurance, you're looking to them to cut a check. So part of our diligence process is requesting, if they're not publicly traded, requesting financials of the seller, to determine if insurance is not necessary. And that's a great comment. This may be completely obvious to some, but maybe not for others. The tax credit insurance, in many ways, is being used as a credit enhancement, right? There's a lot of great developers of clean energy out there that aren't publicly traded and have investment grade ratings. That doesn't mean that our credits are bad. It just means that insurance is going to continue to play a role to bolster their balance sheet.
Great. I think we have one final question that I think is worth addressing quickly because it's about the fiscal year, which is a great question and one that actually comes up quite often. The question is, are there considerations with respect to the fiscal year that the seller generated the credit? So fiscal year is very important to consider, especially if you're a buyer on a fiscal year. The reason for that is if a credit is generated, say, in the 2023 tax year, and you have a fiscal year, then that will apply to your subsequent fiscal year. So for example, if you are a September 2024 or September fiscal year, a 2023 credit will apply to your fiscal year ending September 2024. And so for that reason, we actually get a lot of fiscal year buyers that are telling us, can you please find us 2023 tax credits? Because that's the only way I can use credits for my fiscal year that ends in June or September of 2024. Otherwise, I have to wait until the fiscal year ending 2025. So great question. That's also covered in more detail. We do have a handbook that sort of goes into detail on all of these specific mechanical questions. You can download that at our website as well.
Awesome. So I think we're just about out of time. I am going to pass it back to Maria for some concluding thoughts and some words of wisdom, and we'll see you next time. Maria?
Thank you both. Thank you, Billy and Andy, for a wonderful presentation. That's a wrap. Thanks everybody for joining us today, and we hope you are leaving the webinar having gained at least a few new insights about the IRA tax credit transaction process. Just a quick note, today's webinar is Reunion's inaugural quarterly webinar dedicated to prospective buyers of tax credits. We welcome any and all feedback you may have so that we can continue to improve and make our future sessions as useful to you as possible. We will quickly follow up by email with a short survey and appreciate your candid feedback. Thank you, and stay tuned for more details. Thank you, and until next time.